Alright, good afternoon now, folks. We are at the end of another week of trading. Whether it was a busy week or a quiet week, I mean, Tuesday was a busy day. Certainly after Tuesday, apart from really oil, not a lot of price movement across the board. But we'll try and break that down. Really, the main focus of attention this week, and all we've really got to talk about, certainly in terms of the economic calendar, well, there's a couple of things, I suppose, but certainly in terms of the economic calendar. Inflation out of the US on Tuesday. You can see the headline print: year over year consensus 3.32, drop back from 3.7, miss consensus at 3.2. Inflation over the month of October, including food and fuel costs, 0.1 consensus, actual 0%. Core CPI, again, miss consensus by 0.1. All of these, all four of the prints, all missing consensus by 0.1. Shows inflation further pulling back within the US. Now, they had a miss on inflation. They come into this PPI, which is obviously the producer price inflation, which is the cost of making goods rather than producing goods, right? Cost of making goods, which is producing goods, rather than the cost of consuming goods, which is purchasing goods, right? PPI then is inflation for the producer, consensus 0.1%, and a big miss on that, minus 0.5%, which can be a runner, or is a front runner for CPI. As if it costs less to make things, well, then you can sell them at a lower price. If it costs more to make things, well, then you have to sell them at a higher price. So inflation across the board, whether it's for the consumer, whether it's for the producer, all missing consensus across the US this week. You then look towards last week with the Fed suggesting, a couple of weeks ago, suggesting that the Fed, the dot plot was incorrect. They may not look at hiking interest rates again. They said the dot plot may be incorrect and interest rates may not go higher. Jerome Powell comes in and backtracks on that, as he always does. But CPI lower, PPI lower, dovish Fed, NFP lower. It's been a raft of economic data out over the last couple of weeks from the central bank and then from the economy that all suggests that you sell the US dollar, don't you? I mean, stocks quite clearly popped higher, aggressive moves higher across the S&P. Back end of last week, or over the last couple of weeks, really, it's been a rip higher on equities. You can see from the Fed on Wednesday, back at the beginning of October, just S&P just popped higher off the back of that. Chopped sideways for last week and then has accelerated again this week. But it chopped sideways on Monday, accelerated massively higher on Tuesday, and then Wednesday, Thursday, Friday has just kind of chopped sideways. Is making an attempt at the high, but the Dow Jones the same, the Nasdaq the same. The Russell had a bit of a pullback yesterday, but ultimately the three major US stock indexes all having substantially, having substantial gains over the month of November so far. For me personally, is it really a situation where interest rates are where they are at? The next adjustment of the interest rate is probably a cut. But on face value, is interest rates being at 5.5% good for business conditions? Not quite. But economic data, although deteriorating somewhat, still holding up pretty firm. And if they can achieve a soft landing with interest rates where they're at, the next movement for interest rates is probably a cut. Therefore, stocks can notch substantial upside off the back of that. The DAX, though, has been flying this week. I mean, you might think to yourself, with the DAX, I mean, it's maybe a bit tricky to work out, but you might think to yourself with the DAX, maybe there's a couple of contributing factors with US and China trying to repair some issues between themselves and move forward. Maybe that's suggests a bit of positivity for the Chinese economy going forward. A lot of German companies have strong links to China. Maybe that's a reason. You got interest rates in Europe lower than they are in the US. Plus, the ECB are done. Their next move will likely be a cut, and they are probably likely to cut sooner than the US. So maybe that makes the European stocks a slightly more attractive proposition, or maybe not more attractive proposition, but a attractive proposition for a fresh upside. And that's had extremely strong upside over the course of this month as well. Likewise with the Euro stocks. Inflation lower, helping them to push higher. The FTSE not really doing too much as of now. The US dollar is to notch a negative week. You are making an attempt through the lows here in the dollar index, so we'll be interested to see, do we close? Can we close below 104? Will be the question heading into the close this evening. The trend is pretty clear on all these. You look at your Aussie, Kiwi, Euro and Sterling. The trend is higher. Dollar Swiss, dollar CAD is a bit choppy, but ultimately, you've had some downside this week across dollar CAD, dollar yen downside this week, which will be a welcome sight for the Bank of Japan, who did allude overnight that they are not targeting any specific level for intervention, but I think we all know they do probably have a specific level in mind. But if this can happen organically for them and dollar yen can move lower off the back of maybe a somewhat dovish Fed and some weak US data, well, that is obviously a plus for them. But euro dollar at the highs, the dollar index at the lows. That dollar index, that 104 level, that 109 level on euro dollar are important levels as we head towards the close today. We were looking at this support level in this morning video on the 10-year yield. We did have an attempt through the low there. We failed, had a bit of a false break, and we've popped back inside. Same thing with the 2-year yield. So, I mean, if these pop higher, you expect 104 to be held on to. You expect 109 to be held on to as well. But if these take a turn for the worse to move lower in today's US session, which is still to kick off, maybe that is good indication into next week. I still think the US dollar is a sell going forward. US dollar is a sell, equities are a buy. You probably want to wait for some sort of dip on equities, but ultimately looking at equities, how I would view this is, we've been up at these highs since Tuesday now. There's a clear reluctance to sell up at these highs, which would suggest to me that markets are happy and comfortable and willing to facilitate trade at these highs. If they are happy and willing to facilitate trade at these highs, well then that would suggest to me that the next move is higher. You may not even get your pullback. Markets might just pop higher again. I still would hope for a pullback, maybe a bit of a retracement back into this candle from inflation. 44.50, something like that. Bit of profit taking into the close today would be nice to kind of reload some long positions into next week. Oil, solid mover over the course of this week. You can see Tuesday, that was Tuesday's high, posted at 79.70. We then reached down 72 in yesterday's session, with oil down 4 or 5% in yesterday's session, even over the course of one candle. So massive downside in oil. Inventories continue to build. OPEC exports are down. Clearly a lack of demand, lack of use of oil. If inventories build, it's an increased supply of oil, therefore it's negative for the price. So expect something out of OPEC soon. OPEC, Saudi Arabia, Russia, something to prop up the price of oil soon enough. It's normally what we see when we get any sort of a move lower in oil in recent months. Apart from that, it's sort of where we are at. Gold moving higher in line with that dollar weakness plus yield weakness. Yields pushing lower is more attractive for gold. Dollar pushing lower also means XAUUSD, which is the ticker for gold, means that should push higher as well. A couple of things from the UK. We had inflation from the UK below consensus. Unemployment rates slightly ticking lower, but more progress made in terms of inflation from the UK. A big miss on consumer spending out the UK. Consensus was for a growth of 0.3 in consumer spending, but actual minus 0.3. And yeah, big miss on retail sales. Solid miss on inflation coming under control. Retail sale, or consumer spending should I say, under control somewhat. That is likely to keep the pound somewhat under pressure, which it certainly was over the last kind of 48 hours. As a 4-hour chart, big 1-hour chart clearly has a bit more of a pullback, or certainly over the course of Wednesday and Thursday. Maybe not today, as it is a bit sideways in today's session. But really the main moves came on Tuesday. Apart from that, markets have been somewhat difficult to trade for the duration of the week. Been quite choppy, been quite range bound. Markets slightly unsure as to whether inflation coming down is that really a good thing. I mean, lower inflation means lower demand, which is negative for growth, but ultimately I'm not sure markets really know how to kind of deal with a soft landing too much. Okay, economic data may remain resilient, but ultimately interest rates are where they are at. So but at the end of the day, conclusion of the week, I think the Fed are done. Economic data out of the US does not suggest that another interest rate hike is needed. Retail sales as well from the US below zero. So economic data does not suggest that the Fed need to continue to hike interest rates. That would come with a pause. That is a reason to sell the US dollar, but we'll see how that plays out into next week. At 104 level on the dollar index, 109 level on euro dollar. Keep an eye on those two levels, and we'll be back next week for further updates throughout the week.